Nvidia just proved it's still the king of AI chips. AMD says it can 5 times its earnings by 2030. And at the same time, two of the hottest AI cloud stocks just crashed more than 20% in a week. Meanwhile, Microsoft, OpenAI, and Anthropic are quietly pouring tens of billions of dollars into new AI superfactories that could lock in chip demand for a decade. In this video, I'm going to break down what's really happening behind these headlines, who's actually winning the AI chip war, and how I'd personally think about investing in Nvidia, AMD, CoreWeave, and Nebius in 2025 and beyond. Stay with me until the end, because I'll share a simple 2-bucket strategy you can use to balance AI growth with risk control. Welcome back to the channel. If you're serious about AI and semiconductor investing, you're in the right place. Nothing in this video is financial advice. My goal is to give you clear information and frameworks so you can make better decisions for your own portfolio. Let's start with the heart of the story: Nvidia versus AMD in the latest AI benchmarks. Recently, the latest MLPerf training benchmarks dropped. This is the main industry standard test for AI training performance. And once again, Nvidia showed up everywhere. Nvidia submitted results on every single test. Big language models like Llama, image models, recommendation systems, and claim top performance across the board. That matters. Vendor slide decks are easy to manipulate, but MLPerf is where companies go when they want to say, here's how our chips perform in a fair, standardized environment. Now, what about AMD? This is where it gets interesting. AMD's newer Instinct MI325, MI350, and MI355 accelerators showed huge jumps over the older MI300 generation. In some Llama workloads, they're more than 3 times faster than MI300. On certain Llama 270B training and fine-tuning tests, AMD's MI325X and MI355X are even competitive with, or slightly ahead of, Nvidia's H200 and some B-series parts, when tuned correctly. But when you zoom out to all the benchmarks and all the model types, Nvidia still holds the crown in absolute performance and breadth. So the message is simple. Nvidia is still the performance king with the broadest ecosystem. AMD has gone from way behind to serious challenger on key LLM workloads. The real headline from Nvidia is its new Blackwell Ultra GB300 system. In the latest benchmarks, a single GB300 NVL72 system delivered up to 4 to 5 times the performance of the older Hopper generation on massive Llama models, using the same number of GPUs. In practical terms, imagine a training run that used to take 1 hour on older hardware, now finishing in around 15 minutes. That's why Microsoft, Anthropic, OpenAI, and others are still writing huge checks to Nvidia, even while they design their own chips. Speed is money. Whoever can train larger models faster and cheaper gets a real advantage. So yes, AMD is catching up fast, but at the very high end, especially in massive, multi-node clusters, Nvidia's GB300 Plus software stack still looks like the system to beat. Now let's talk about drama, CoreWeave, and Nebius. In the last few days, CoreWeave stock has dropped more than 20 to 25%, and Nebius is down around 20% from recent highs. CoreWeave cut part of its revenue outlook after delays with a third-party data center partner. The market hates uncertainty, and the stock sold off hard, even though demand for Nvidia GPUs is still strong. Nebius, meanwhile, has massive growth and multi-billion-dollar AI infra deals with companies like Meta and Microsoft, but it also pulled back sharply after its latest earnings and guidance. So what's really going on? These names rallied hundreds of percent as pure-play AI infra stories. Now, every small disappointment, a delay here, a slightly weaker quarter there, triggers brutal corrections. For long-term AI bulls, these pullbacks can look like opportunities. But for cautious investors, they're a reminder: hype cuts both ways. Personally, I treat CoreWeave and Nebius as high-risk, high-reward satellite positions, not core holdings. Now, back to AMD, because they didn't just show strong benchmarks. They also made a huge promise at their recent Financial Analyst Day. AMD says the AI and data center market could reach around $1 trillion later this decade, and that if they execute, they can grow earnings from roughly $4 per share today to about $20 by 2030. That's roughly a 5 times EPS target in about 5 years. If they're even close to right, today's valuation could look cheap in hindsight. If they're wrong, the stock can still get punished hard. So for investors, the key question isn't, is AMD a good company? It's, how much of this AI dream is already priced into the stock? And how much execution risk are you comfortable taking? Behind all of this is a bigger story: AI superfactories. Microsoft is building its new Fairwater AI superfactory, connecting massive data centers in Wisconsin and Atlanta, designed for ultra-dense GPU racks, liquid cooling, and custom networks built around advanced Nvidia systems. OpenAI just released its new 5.1 model, pushing conversational AI even further. Every new generation requires fresh training runs and more inference capacity. And Anthropic announced plans to invest roughly $50 billion into new AI data centers in Texas and New York in partnership with FluidStack, creating thousands of jobs and huge demand for high-end compute. All of this tells me one thing: big tech isn't treating AI as a short-term experiment. They're building long-term infrastructure, like railways or the early internet. That's bullish for Nvidia, AMD, and the AI infra players, as long as the returns on all this spending eventually justify the cost. Before we finish, let's be honest about the downside. If AI demand grows slower than expected, or if monetization disappoints, many of these smaller AI infra stocks could end up like the old quantum computing hype names: huge drawdowns, painful bag holders. So here's a simple way I'd think about positioning. Bucket 1, core AI backbone. Nvidia, AMD, Microsoft, maybe Broadcom. These companies benefit from AI, but also have diversified businesses. Bucket 2, AI infra moonshots. CoreWeave, Nebius, and other GPU cloud players. Small positions only. Size them as if you're willing to see big volatility and even 50% plus drawdowns. For many investors, it might make sense to keep 70 to 80% of their AI exposure in that core backbone and only 20 to 30% or less in the moonshots. Your exact numbers depend on your risk tolerance and time horizon. If you found this breakdown helpful, let me know in the comments. Which AI stock are you most bullish on right now? Nvidia, AMD, CoreWeave, Nebius, or something else? And if you want more deep dives on AI chips, data centers, and the companies building this new infrastructure, make sure to like the video, subscribe, and turn on notifications so you don't miss the next one. Thanks for watching. Take care, and I'll see you in the next episode.